Hey there, investors! Welcome back to another 2025 market update. Feeling a little jittery after the recent market roller coaster? Don't sweat it. It's completely normal to feel a bit uneasy when the market takes a wild ride. Short-term volatility is just part of the game. It's like the market's way of keeping us on our toes. Remember, the stock market is a powerful beast. It has its ups and downs, but over time, it tends to grow stronger. It's built for the long haul. Think of it as a marathon, not a sprint. Patience is key. So take a deep breath, and let's break down what's really going on. Understanding the bigger picture can help ease those nerves. The market had a bit of a stumble lately, yeah, but that's not the end of the world. The Federal Reserve threw us a curveball in December. They made some unexpected moves. They're pumping the brakes on those interest rate cuts we were expecting in 2025. This has caused some ripples in the market. But hold on, that doesn't mean the sky is falling, it's just a temporary adjustment. The market's like a bucking bronco. It throws a fit now and then, but it always settles down. And when it does, it's usually stronger than before. History has shown us that the market tends to recover and grow. So, buckle up, hang on tight, and get ready to ride this thing to bigger and better returns. Stay confident, stay informed, and keep your eyes on the long-term prize. Okay, let's talk about the elephant in the room. The Fed's December announcement. They basically said, hold your horses, folks. We might not be slashing those interest rates as much as you thought. Instead of the 4 cuts we were hoping for in 2025, they're now hinting at just 2. Now, I know what you're thinking. 2 cuts? What gives? Well, the Fed's got their reasons, or at least they think they do. They're worried about inflation rearing its ugly head again, and they're concerned about the economy overheating, so they're tapping the brakes a bit, trying to keep things from getting too wild. But here's the thing, the Fed doesn't always get it right. Remember back in insert year when they said insert inaccurate Fed prediction? Yeah, exactly. Let's be real, folks. The Fed's track record on predictions isn't exactly spotless. They're like a weatherman who constantly predicts sunshine, then gets caught in a downpour. Remember when they said inflation was transitory? Oops! The truth is, the economy is a complex beast. It's influenced by a million different factors, many of which are impossible to predict with 100% accuracy. So, while the Fed does its best to read the tea leaves, their forecasts are far from foolproof. They're like the rest of us, just trying to make sense of this crazy market. So don't base your entire investment strategy on their every word. Take their predictions with a grain of salt, and focus on what you can control, your own long-term investment plan. Section 4, the Great Melt-Up, riding the wave of asset inflation. Now let's dive into this whole Great Melt-Up phenomenon. It's a term that's been buzzing around financial circles lately, and for good reason. You see, we're not just dealing with regular old inflation here. This isn't just about the price of milk or gas going up. We're talking about asset inflation, which is a whole different beast. It's when the prices of assets like stocks, real estate, and even cryptocurrencies start to skyrocket. That's when the prices of things like stocks, real estate, and even crypto go bananas. But why is this happening, you might ask? Well, you can blame it on all that easy money sloshing around the system. The Federal Reserve has been printing money at an unprecedented rate. The Fed's been pumping out cash like there's no tomorrow, trying to keep the economy afloat during tough times. And all that cash has to go somewhere, right? It's not just sitting in bank vaults collecting dust. So it's flowing into financial assets, pushing prices higher and higher. Stocks, real estate, and even cryptocurrencies are seeing massive inflows of capital. Now, some folks are freaking out, calling it a bubble. They worry that these inflated prices can't be sustained. And hey, maybe they're right. Bubbles do have a tendency to burst, often with dramatic consequences. But here's the thing. Even if it is a bubble, it could keep inflating for a while. Markets can stay irrational longer than you can stay solvent, as the saying goes. And if you're smart about it, you can ride that wave to some serious profits. Timing is everything, and with the right strategy, you can make the most of this asset inflation. Section 5, Debt Dilemma, how higher rates squeeze the economy. But Jim, you say, what about all that debt? It's a valid concern, and one that many people share. Debt is a huge part of our economy, from personal loans to government bonds. Won't higher interest rates make it harder for the government to pay its bills? Absolutely, and not just for the government. Households and businesses will feel the pinch too. You bet your bottom dollar it will. Higher interest rates mean higher costs for everyone who borrows money. See, when interest rates go up, so do the payments on all that debt. This isn't just a minor inconvenience, it can have major repercussions. And that means less money for things like infrastructure, education, and all the other good stuff the government spends money on. These are essential services that can suffer when budgets get tight. Plus, higher rates make it more expensive for businesses to borrow money. This can stifle innovation and expansion. That can slow down investment and hiring, which can put a damper on economic growth. It's a vicious cycle. When businesses cut back, it affects everyone. So yeah, higher interest rates can be a real drag on the economy. They can lead to slower growth and even recession if not managed carefully. But here's the kicker, they can also help to keep inflation in check. By making borrowing more expensive, they can cool down an overheated economy. It's a delicate balancing act, and the Fed's trying to walk that tightrope without sending us all tumbling down. The goal is to find that sweet spot where the economy can grow steadily without runaway inflation. Section 6. Why more rate cuts might be on the horizon. Now I know the Fed's saying they're only planning on 2 rate cuts in 2025. But let's be honest, they might have to change their tune. Why? Because the economy might need a little extra juice to keep chugging along. If inflation cools down more than they expect, or if the economy starts to sputter, the Fed might have to reverse course and cut rates even more aggressively. Remember, their main goal is to keep the economy humming along at a healthy pace. And if that means cutting rates, then by gosh, that's what they'll do. So don't get too hung up on their current projections. The Fed's got to do what's best for the economy, even if it means deviating from their original plan. Section 7. Stay calm and invest on. The long game wins. Look, I get it. The market can be a scary place, especially when it's bouncing around like a bouncy ball on a trampoline. But here's the thing. The long-term trend for the stock market is up. Always has been, always will be. So, what's the best strategy? Don't panic, don't try to time the market, just stay invested, keep buying those dips, and let the magic of compounding work its wonders. Remember, time in the market beats timing the market every single time. So take a deep breath, relax, and trust in the power of the market. The future is bright and your portfolio will thank you for it.